Hello, everyone. Welcome to the AAPI educational webinar about estate planning and tax saving strategies for physicians. This event is hosted by AAPI, and I'm moderating this session. This is an educational webinar, and attendees should consult their own advisors and attorneys for any advice. In this webinar, what we have done today is to put a few frequently asked questions for the previous webinar, so it's not a long and boring presentation. I will ask questions and Mr. Syed will answer them. You can ask your questions as well in the chat box. Those who joined via Zoom or can ask in the CME room, as you can see us both. Just a brief introduction about Mr. Syed. Mr. Syed has been instrumental in organizing several webinars in AAPI, which all members so far have really enjoyed and also benefited by. Mr. Syed is a fiduciary financial advisor and partner at the Wall Street Alliance Group. His articles and interviews about asset protection and common financial mistakes by physicians are published in MedPage Today and Medscape. He is regularly quoted and interviewed in media outlets like Forbes, KevinMD, US News, Investment News, and Yahoo Finance. Syed, thank you very much for hosting this for all our members. You're welcome. So we'll start first on estate planning. The first question that I have for Mr. Syed is, without sounding like a lawyer, in simple, plain English, can you please explain what are the components of estate planning?
Yeah, first of all, thank you, Dr. Samadder, and is glad to join you. I think this is your first webinar with me after you become the president, and you can see almost 200 people have joined so far. It's only a few minutes, so really appreciate you organizing for the AAPI audience, and thank you very much for what you do for AAPI. It's a thankless job, but really appreciate what you do. And we're looking forward to having a long-term relationship with AAPI. Now, one of the question people ask that estate planning, like a very interesting question you asked, like without sounding like an attorney, tell me basic what estate planning means. I want to tell you a story. One of my clients traveling from India landed in New York, got a stroke. Right now, admitted into the hospital right now. Immediately landed in New York, got into, a first stroke, recovered, and now got second stroke, but now in ICU. Now, you might be thinking what that has to do with estate planning. The reason I share this small incident with you is because if this client didn't have something as simple as basic, let's say, for example, a power of attorney, because before the client actually becomes seriously ill, he actually have the, I think, Johan, you have to mute, Dr. There's another one.
No. This is Dr. Samadder's husband. I'm joining.
Hi.
Hold on 1 second. Yeah.
It will echo. You can see me okay?
Yeah. Thank you.
All right. Very good. So as I was concluding that in this client situation, right now he's in ICU, but I'm glad that before the client becomes seriously ill, he had the basic estate planning done. So what does basic estate planning mean? Number one, the most important things is the power of attorney. You need to have it. Like in this client situation, he was pretty much running the whole business for my physician client. So since my client actually had the power of attorney, she was actually able to call on behalf of him and make all the decision about the retirement account, about the brokerage account. So number one, power of attorney. That's extremely important. Number two is health proxy. Like in this client situation, life and death situation, like a power out, power in, comatose situation, who will make the decision? That's called health proxy. That's what you need. So these two components together are called living will. And another good important component of estate planning is basically called a will. What is a will? Will is a public document. What it means that if anything happens to you, the will basically goes to public and the court decide according to your wishes who will take the custody of the children and also how the assets will be distributed. So to summarize your question, hopefully it makes sense in my client's situation. The most important thing while he's alive, the power of attorney, health proxy, and after he pass away, you need to have a will as well so the court can distribute according to the wishes. One problem to some other that in America, even just have a will, it's not like tomorrow, you pass away, the court actually get the money the next day. It goes to something called a probate process. You can avoid all of it by simply creating a revocable trust. So this is optional, but the most important thing is will, and which is called last will and living will. Trust is optional depending on your situation. Hopefully, it's kind of summarize what basic estate planning means.
Okay, so you're saying will is not enough, trust is needed too. What are the benefits of a trust?
Yeah, a lot of people ask that, hey, I have, the, beneficiaries all said, why do I need to have a trust? Is will enough? Depending on your situation, depending on your net worth, if you just have a house and a retirement account, most likely will is okay. But according to my experience, like most physicians are high net worth, they have other assets beside the retirement account as well. They have real estate, they have brokerage accounts. So we recommend to have a revocable trust as well. Now, what are the benefits? Number one benefit, as I mentioned, trust is a private document. Will is a public document. So, you create the trust while you're alive. You move the house under the name of the trust. You move the brokerage account under the name of the trust. So in this way, if anything happens to husband and wife, no probate, nothing whatsoever. You avoid it. And probate could be very costly. And in some state, like you are in, I think, Ohio, it takes almost 3 months to 6 months. So you can actually avoid all of it by creating a revocable trust. Second benefit of a revocable trust is after you pass away, husband, wife, that revocable trust becomes irrevocable by law. Children inherit the money through the revocable trust, which become irrevocable after you die. A divorce happen, a lawsuit happen, all the assets are protected. So for divorce protection, asset protection for the children, you should create a trust as well. And number three is a little technical, but I just want to talk about it. Step up in cost basis. For example, you bought Apple share at $100. Apple share is $150. You pass away, you give this money through the trust. The children inherit the money. Their cost is 150, not 100. So the difference between 100 and 150, they get a step up. So these are the three major advantage of about having a revocable trust as well. So that's why most of the time we recommend for our physician clients to have a revocable trust as well.
So what are the common mistakes that physicians make when creating this will and trust?
Yeah, for the last 17 years, as a fiduciary advisor, there are three major mistakes we see physicians make all the time. Number one mistakes we see that, in the will or in the trust document, they say if anything happens to, let's say, for example, me and my wife, we put our son's name directly, give it to them under their individual name. I think logically, Dr. Samadder, that the children becomes older, let's say at the age of 21, they inherit the money, and at 25 or 30 they married and divorce happened, asset becomes half. So our recommendation, don't give it under their name. What you should do on the documents, basically, put a provision, they must create their own trust and transfer money out. Our recommendation, number one. Number two, you must title everything, funding it. People don't do it. Like, for example, this client of mine who is sick right now is a new client, just to give you an idea. But we were unable to fund everything, move everything under the name, the house, the brokerage account, stuff. So if this client were to pass away, he will not avoid probate. So because the house has not been moved, the brokerage account has not been moved. So make sure you move everything under the name of the trust as well. If you don't move it, it's a fancy document collecting dust. And third, a lot of physicians move, like have a lot of retiree clients that are moving from one state to another, and their trusts are 5 years, 10 years old. To be honest with you, every 6 years you should update it. So if you move from, let's say, New York to Florida, they have different statutes. It's a single page, one single page document. My recommendation when you move to that particular state, update the statutes as well. So these are the three major mistakes we see people make their overall estate planning.
Okay. How often should you update the will and trust documents? How much does it cost for basic will and trust generally?
Yeah, so our recommendation usually every 5 to 6 years, depending on your circumstances, we should at least take a look. And the provisions, everything keep changing. So our recommendation is every 5 years, take a look and update. And sometimes children become older. How much does it cost? Is a good question. Will, trust, power of attorney, health proxy cost between $2,500 to about $3,500. Our experience has been. That's what the range is. So depending on the state you live in. And small updates, it costs few $100s every few years. That's what my experience has been.
Okay, it seems like in USA, we pay taxes to be alive when you're alive and also after you're dead. What is estate tax or death tax? How does it work?
Yeah, so you're right. Unfortunately, in America, you have to pay taxes while you're alive. You have to pay taxes when you're dead. So the good thing is that when Trump became president, the threshold for the state tax has changed. So right now, husband and wife both passed away. Your net worth needs to be more than 24 million. Only then you pay 40% taxes. But unfortunately, you have to worry about few states, they have their own inheritance tax. For example, Pennsylvania, they have their tax called inheritance tax after a certain amount. New York, after a certain amount, you have to pay that New York state tax as well. So those are there, those not changing. So unfortunately, you do have to worry about death taxes, but there's one thing to understand. As of right now, the amount is 24 million, is changing in 2 years, is expiring. It's coming down, husband, wife, both passed away. Anything more than 12 million, you have to worry about paying almost 40% state tax. So I think it's a good time, depending on the election, what becomes next year, it's a good time with your financial advisor, sit down and see that depending on your net worth, most of our physician clients are high net worth, whether it makes sense to do some planning or not.
Okay, for those who are high net worth, which is not me, but let's say Donald Trump, what are the strategies to lower your estate taxes before year end?
You are kind of muted. Let me see.
Oh. Am I? Yeah,
Let's
someone
see,
muted
hold
me.
on.
No, Dr. Samadder, you were fine. There is something with Syed's connection, I think.
Can you hear me now?
Yes, we can. Dr. Samadder, you are muted now.
Can you talk
unmute
now?
yourself.
Sorry. Okay.
Yeah.
For those, Syed, for those who are high net worth, which is of course not me, of course, but let's say that someone like Donald Trump, what are the strategies to lower your estate taxes before year end?
Yeah, few of the suggestions. I won't go through all of it, but number one, there's something to talk about SLAT, Spousal Lifetime Access Trust. In a SLAT, you can gift right now, before the law change, almost 22 million, and this money is completely out of your state. Every year you can gift your children. It used to be 16,000. Right now, almost $17,000 per child per parent. About 34,000. The money annually you can gift it. No gift tax required needed. Money is out of your state. You can buy second to die life insurance policy that can actually pay for it. Is very cheap. You can move the life insurance under an irrevocable trust. Once you move the life insurance into an irrevocable trust, after 3 years, the death benefit is out of your state. And last, I will touch base really quick, which is beyond the scope of today's presentation, which is charitable planning. So for example, a lot of physicians close to retirement, they do charity. After you pass away, the money can go to something called a charitable lead trust. There's no taxes in it. And you can structure in such a way that after 20 years, 30 years, the money go back to your family. So again, we're not going to go that detail into it, but I think these few suggestions I have it will be a good touch-up point to talk to the financial advisor. If your net worth is more than 15 million, which one makes sense for you?
Okay, great.
Dr. Samadder, before we move into the next topic, there are
Sure.
some questions in the Q&A chat
Mhm.
box. If you can read those,
Of
would be great.
course. This question is by Raja Vadlamudi, Dr. Raja Vadlamudi. Some of the retirement accounts or investment accounts does not allow to be under the trust. In this situation, if we have the trust as beneficiary, would be the same as being in the trust?
Yeah, most retirement account or investment accounts, some custodian we have seen give you hard time to have it owned by a revocable trust. We'd have seen it. So in that situation, open up something called TOD, transfer on that account, and make the trust as a beneficiary. Retirement account, I'm saying, so retirement account, we will talk in our webinar in few slides, something called Secure Act Pass also. So if you cannot put under retirement account the revocable trust, just put the child as a beneficiary directly if the retirement account doesn't allow it. But 90% of the times we have seen the custodian does allow it. If you run into the situation, one option could be have the individual beneficiary directly there, but unfortunately, that may, depending on what kind of account is it, that may lead into some probate process. But at least my suggestion is to still put some beneficiary name there rather than having it completely blank.
Okay, there's another question. If someone already has a trust, can they transfer it to another firm like yours? Or
Yeah,
some other firm?
Yeah, so remember the trust doesn't need to be transferred. All someone needs to do, an attorney can update it. We have attorney who can actually help you, and you can have any financial advisor who usually work with an attorney who can help you to update the will and trust as well.
Okay, so the next question, we'll get to that, is can you give me an example of the spousal lifetime access trust you just spoke about a few minutes back?
Yeah, one example, a lot of people not understanding, I think, spousal lifetime trust. So the way people ask, like I jokingly all the time say in my presentation, like my mother-in-law is very rich and she always, thinks that I marry her daughter for her money. And I did, she's very rich. And she said, is there any way I can actually gift money to my daughter, but you don't have access to it. So it's called spousal lifetime access trust. In a spousal lifetime access trust, you can each gift 11 million each, almost 12 million each. As long as one of the spouse is alive, you can use the spouse and take money out and use it for yourself. So that's why it's called spousal lifetime access trust. So you have access to the money, you don't lose control as long as the spouse is alive. So this is one way of gifting money. The children eventually get money after both of you pass away, but in this way you can control it. The funds goes to the children later on. Let me just give you an example from a number perspective. Let's say your net worth is 25 million and you have a $4 million life insurance and husband, wife both pass away right now. I'm talking about. I'm just hovering my mouse. If the law does not change, remember 4 million life insurance, $25 million net worth. We're talking about a 3.5 million state tax that's due. Now, in 2 years, in 2025, if the law changes and comes down, 6 million each, 12 million, we're talking about a 9 million state taxes due. Husband, wife both pass away. Now, a simple solution I'm just giving you. Let's say from this 25 million, 13 million, you use the spousal lifetime access trust, you gift it to the children. And the 4 million life insurance, you have it, you move it into an irrevocable trust. So almost, 17 is out of your state completely. And if you pass away right now, the state taxes is zero, almost. The saving is almost 8.5 million. So again, just a simple math I showed you. This is more to it, but I just want to show you that there are formulas like this available out there. You sit down with your estate planning attorney and financial advisor who can give you further guidance.
Okay, so the last questions on estate planning. What is Secure Act 2.0? How does it affect estate planning?
Yeah, so Secure Act is setting up the whole community up for retirement enact. This is the act passed. First, it was Secure Act, then it was Secure Act 2.0, which became law, passed last year. There's a lot of provisions there. The most important thing, you just have to learn it, that according to Secure Act, if you have an adult children who are the beneficiary, husband and wife both passed away, that previously what it used to be, Dr. Samadder, that let's say I pass away, my son is 21, that my son 21 has their whole life, his whole life, slowly start taking money out. It's called required minimum distribution. The money will grow, he takes some money out. That was the whole idea, called stretching the money. Secure Act passed last year. Now my same son, who's 21 years old, pass away. Now that child has only 10 years to withdraw all the money. You might be thinking, what's the big deal? It is a big deal because most of physicians like yourself have 401k with the hospitals. They have high net worth. They put too much money in 401k. Now this 401k, previously the children has their whole life to slowly take money out, but now they have to take everything out in 10 years, huge taxes due. So that's why you might be thinking what that has to do with estate planning. Something should be done because previously it used to be easy. Most of the trust people created, Dr. Samadder, are not equipped to handle this. You have to put these provisions there. The planning needs to be done. So what are the planning? Number planning is the revocable trust. If is the beneficiary of a retirement account, you have to incorporate the planning that can facilitate that 10 years distribution to the children. Is very important. Previously, they had this provision called stretching it. It's not there anymore. Number two, you can do, a lot of physicians don't aware, you can do something called a Roth conversion, like the 401k, you have it with the hospital, convert it into a Roth IRA. You pay the taxes now, but let's say the market is down, you're in a low tax bracket, but the benefit is the children, when they inherit the money, still they have to take the money out in 10 years, but there's no taxes. One option could be. Number three, the 10 years rule is for adult children who are 21, but if they are minor, it's not applicable. So I'm talking about a lot of retirees, Dr. Samadder, who are like, have grandchildren. One option could be name them as the beneficiary of the retirement account. So the 10 years, let's say the grandchild is 2 years, the 10 years doesn't kick in when they are 21. So they have enough time to grow. That could be one more option. And then a couple of other solutions. They can buy like a second to die life insurance policy. It's the same philosophy like state taxes. And then a lot of people are charity minded. So if you're charity minded, one option could be after you pass away, make the retirement account as the beneficiary for the charity. So in this way, more money goes to the charity so that don't have to worry about the 10-year rule. Don't give the brokerage account to the charity, give the retirement account to the charity like AAPI. I'm just giving an example. So these are a few of the examples. I'm actually, it could be either or, could be combination, but it is, a lot of physicians are not aware of it, that the 10 years rule for the retirement account, they all have a lot of pre-tax money in the 401k. The children will be hit with a lot of taxes. Do some planning if you can.
Dr. Samadder, there are a lot of questions coming in the Q&A box.
Right.
If you can read some of them, please.
Yes, absolutely. If you have children as beneficiary to your brokerage or bank accounts, does it not get transferred directly on death?
It does. So remember, if you have beneficiary, it is fine. Don't have to worry too much about probate. But remember, like you mentioned, if we don't recommend directly give it under the name of the child, because if the child, at the age of 21, 25, inherit the money, or let's say 30, inherit the money, get married, get divorced, asset become half. So that's why if your net worth is substantial, we recommend give it to the revocable trust, which will become irrevocable after you pass away. So that's what we recommend all the time.
Okay. Should retirement account be moved into trust?
Retirement account cannot be moved under the trust. The beneficiary of the retirement account needs to be the revocable trust. And remember, the 10-year Secure Act 2.0 provision should be there, so the children can exhaust the money within 10 years.
Okay. The next question is, if I transfer 200,000 to Roth IRA this year and next year, I put another 200,000. When do I have access to this money? 2029 for all money or gradually?
Yeah, there's something called a 5 years rule. You have to worry about, Roth conversion, Roth IRA. Remember the principal, you can take it out, but the growth portion, there's something called a 5 years rule, or also for 59 and a half. So these two rules must be followed.
Okay. Right. If you want to help out relatives in India, what arrangements can be made through estate planning?
Yeah, unfortunately, a lot of physicians ask this question that I have my properties in India. What can we do? Will and trust. It doesn't work over there. You have to have your will and trust there. There's no trust there. You have to have a basic will in India.
Okay, that's great. The next question is estate tax example. It is 40%. How come it is only 3.5 million on 25 million asset?
Yeah, so state tax example is 40%. How come it's only 3.5? So we're assuming that the law doesn't change. So remember, $25 million, up anything more than 20. So to go back to this example, I think she's referring it to how 3.5. So remember, this person has a $4 million life insurance as well. So that needs to be added in the 25. That becomes 28. So that's why the state taxes does go up.
Okay, what is generation skip trust?
Yeah, you can actually create the trust in such a way that your generation doesn't pay the tax. The next generation pay the tax if you have grandchildren. But all it's doing is the tax is actually accumulating for the next generation. So if you have high net worth, let's say more than 20 million, one option could be you can put the GST there, general skipping trust. Yeah.
Okay, so our BOT chair has a question for you. How young, Dr. Lokesh Adara, to have their own will? Does someone need to be 18 years old, or you can make a trust when you're younger?
You can make a trust as soon as you're born. But what I was saying that it's not the age, is the assets you have it that make a difference about the trust. Like I mentioned, you don't want to like overspend with the attorney bill. If it's just like a basic house you have it and a brokerage account, will is enough, honestly speaking. And health proxy, remember I spoke about, but we would like to see net worth at least more than $1 million. To create like a revocable trust, so you avoid probate and all of it, and the attorney cost makes sense.
Okay. The 10-year rule for minor grandkids start at age 18?
21.
Okay, got it. What is second to die life insurance and how can it help?
Yeah, so basically what happened that one of the planning of estate planning is that estate taxes are due. Can we like a buy life insurance? Remember, there's no estate taxes due if one person pass away. Both needs to pass away. Net worth needs to be more than 24 million to have estate planning tax kick in. So if you don't want to do anything, one option could be if you are young enough to buy a second to die life insurance policy. The way it works, one person die, nothing happens. Second person also die, life insurance policy face value kick in. Usually is very cheap, is because both needs to be died. So mainly we use it for estate planning purpose. If your net worth is substantial, you can think about buying second order life insurance policy.
Okay, what can you do as estate planning for the benefit of a grandchild with special needs?
Yeah, special need, today's webinar, we haven't covered too much. That could be a different webinar. So special need trust is a completely different ball game. For example, you cannot have any assets more than $2,000 under the name of a child with special need. Just to give you a gist of it, we're not going to spend too much time because today's are mainly basic will and trust we're talking, but just to give a gist of it, one solution could be having a special need trust. You can create it. You can make it irrevocable or revocable. All the assets goes under the special need trust. In this way, nothing will be under the name of the grandchild, will be the name of the special need trust, and the government benefit, everything will prevail. But then there are more to it, like guardianship, there's something called, you need to have a blueprint of the child health situation. So we can have a full webinar for that.
Okay, great. Can we have brokerage fund or bank account not move into trust, but trust named as beneficiary?
Yeah, one option could be then don't move it, just have a TOD like I mentioned, and have the trust like one of the beneficiaries, and in this way the money goes to the trust. That's fine too.
Okay, can you explain a little more about Roth IRA, please?
Yeah, so Roth IRA is in a pre-tax IRA account, when you put the money like a traditional IRA, the money is pre-tax. At the age of 50, you can contribute almost $7,500. All money is pre-tax, but you do have to pay tax later on when you take the money. Roth IRA, on the other hand, you contribute the money is post-tax. Money grow tax-free. Withdrawals also tax-free after the age of 60, but after 5 years, qualified reasons, you can actually take money out from a Roth IRA as well. Now, Roth conversion, I think for physician is very important because in order to contribute into a Roth IRA, you need to have certain amount of income. If your income is more than that, you don't qualify. But one option could be do a Roth conversion because there's no income restriction there. And once you convert, the money grow tax-free. So if the market is down, it does make sense to do it at that time.
Okay. If I take second to die life insurance policy in a revocable trust, children as beneficiaries, do they get money without paying tax?
Yeah, so second to die life insurance policy, the children get without. So remember, there's no income tax on life insurance, but the life insurance proceed. If it's in an irrevocable trust, the money is out of your state. If the money is under your name, it will be added to your net worth. And if the net worth is more than 20, 22, 24 million, there's the state taxes due.
Okay, how can you transfer your assets to nieces and nephews?
Yeah, so remember the irrevocable trust, the same philosophy applies like the way for the children. You can directly gift it if you want to, that's fine. You can outright gift it, but most of the people want to control it. They want to gift in such a way they could have some control. They just want to give it slowly. So that's what trust comes into play. We're a big proponent of irrevocable trust. So in this way that you have a control when they have access to it, you avoid the probate process, asset protections are there. So we recommend, if it's all possible, irrevocable trust, depending on how much you want to gift.
Okay, for the second to life die insurance, who do you think will be a good tax advantaged beneficiary?
Yeah, so second, the tax advantage beneficiary, it should be, in my opinion, the irrevocable trust that will pay for the state tax it might be due. And then, the money goes to the trust, the children, you can put the trust provisions there, and the children, can take money out according to the provisions of the trust.
Okay, Syed, now I really hate paying taxes. Any
Yeah.
tax planning tips before year end?
Yeah, so the second part of this presentation today is the tax planning. So there are a few tax write-offs. I just want to talk very briefly. When Trump became president, the state and local tax, the maximum deduction is 10,000 called SALT. But recently, a few states like Illinois, New York, New Jersey, Georgia, California, those states enacted a law like if you have your own corporation, like the Samadder, and you elect to pay the same state tax from the corporation, you get full deduction. It's not automatic. You actually tell your CPA to do so. So again, if you have your own corporation, ideally S Corp, pay the same state tax from the corporation. Federally, you can get to write off. Number two, if you need a bigger vehicle, this is a good year to do so. I'm not saying buy a Rolls Royce or anything, but I'm saying that if you need car for a business, if the car weigh more than 6,000 pounds, like for example, Tesla Model X is almost 50, 60,000. You buy it, use it for the corporation, full write-off if it's needed, because this feature is expiring in 2 years. Tax loss harvesting, like some of the stocks are down recently, like Bitcoin, those things. If those are down before December 31st, sell those, and Bitcoin, you can buy it back immediately, or stock, you can sell it and wait after 30 days and buy it back. And this loss can carry forward. So if you have a real estate gain, you can get to write off from there as well. A lot of physicians, Dr. Samadder, are selling their practice. Independent physicians are selling it. When you sell it, make sure to speak to the lawyer about something called a goodwill. Like when you sell your practice, there's an income tax that's due. It's ordinary income though, 40%. But if you put, let's say, because of your name, Dr. Samadder, like if I Google you, you are very popular. I mean, because of your name, patients come. So let's say you have your own practice and you're selling it, and you put 40% of the practice as a goodwill while you're selling it. The 40% portion, you only pay long-term capital gain, which is only 20%. So again, the difference is 40 versus 20. So again, speak to your attorney about goodwill if it makes sense while you're selling your practice. Charitable contribution. This is so after December, you cannot do any charity. So let's say if you're charity minded, you can open up like a donor fund. Fidelity, Schwab, they all allow donor fund, no cost to it. So if you know next few years, whatever charity you're going to give, you lump it together, open up a donor fund, put the money into it, and from there you can write a check, like to AAPI, for example. The advantage is you can get a bigger deduction, but all of this needs to be done by December. Donate appreciated stock. A lot of time, Dr. Samadder, I see people giving cash. One option could be if you have a long-term capital gain stock, donate the appreciated stock. In this way, on the appreciation, you pay no taxes either. Again, extremely powerful. So rather giving cash, donate the appreciated stock. If you have your own practice, consider hiring your children in the payroll as long as they have a need for it. The benefit is that the children, you can give them like say $10,000 to $15,000. They can open up a Roth IRA for themselves and use the money for educational in the future. And last two, very quickly, solo physician can open up a defined benefit plan and a solo 401k and a defined benefit. You can contribute almost $200,000. The money is completely pre-tax. Ideally, you should do it before December 31st because the defined benefit calculation is based on wage and in age. So the more is the wage, the more is the contribution. And lastly, for who are hospital-based employee, max out their 401k, 403b, because after December 31st, you don't have the option to max out. So I know I went through a long list of a short question you asked, but the audience can take a picture, sit down with the CPA and see which one is applicable for them.
Okay, the next question. A lot of physicians are, like you stated, close to retirement, and they have required minimum distribution. Any tax planning tips for them?
Yeah, few tax planning tips for physicians who are close to 73. They have RMD. Before Secure Act, they are 70 and a half, but right now 73. So if you have RMD, RMD, you have to pay, the taxes when you take the money out. One option could be rather having an RMD, you can do something called QCD, which is called Qualified Charitable Distribution. In a QCD, what happened, the money goes directly from the retirement account to the charity of your choice. A lot of people say that, hey, I don't want to put all my RMD via QCD to a charity. I want to control it. Is there any way to control it? I want to slowly give it. You can open up like a private foundation, 501c, up to $100,000, the QCD, you can do it to the private foundation. From there, slowly you can write a check if you want to control it. But again, rather doing an RMD, try to do a QCD, it makes a lot of sense. For retiree, most retirees I know, they are moved to maybe Florida, those cheaper state, and they are into a low tax bracket most of the time. And if the market is down, if you're in low tax bracket, one option could be do a Roth conversion. Because remember, when you do a Roth conversion, the money go tax-free. A lot of physicians don't need the Social Security, but again, depending on your situation, Social Security, you don't have to collect it until 70. I mean, you can delay it until 70 if you want. So if you're 66, if Social Security is hurting your overall income, you can delay until 70, and you will get a higher pay if you need it. Now, IRA contribution, previously after the age of 70, you could not contribute into IRA, but now Secure Act allow it. You can contribute into IRA account and private foundation. So I'm saying it that if you're charity minded, after December 31st, you cannot donate. If you're very charity minded, think about opening up a private foundation. It gives you more flexibility compared to like a donor fund. And lastly, every year, $17,000, you can give it to children, grandchildren, and this money is out of your state if your net worth is substantially high. So these are kind of caters towards people who are close to retirement. So hopefully they can use some of the strategies here.
Okay, Syed, what are the important tax deductions not to miss for physicians?
Yeah, so far, Dr. Samadder, we spoke about tax saving strategy. Now we're talking about deduction, not to miss. Number one, we see a lot of CPAs are prone to do something called standard deduction. Like because the standard deduction is $26,000, it's very easy. Go for standard. Don't want to think about it. Hey, you know what? You may have some, travel expenses. You may have some charity, you may have some mortgages. Why don't you try to lump it together and see if you can go over the $26,000 limit? So try to do itemized deduction if you can. Number two, this is actually for my clients who invest into real estate. My Gujarati client, they do a lot of real estate. So if you invest into real estate in America, there's something called depreciation. Usually so depreciation means the property becomes older. You can get to write off the depreciation from the rental income. Residential, the depreciation is 29 year, commercial is 39 year. But the schedule, Dr. Samadder, is up to you. Meaning, if you want to bring it down from 39 years or 29 years to 5 years, you can. I had a client in Texas, bought a surgical center for $1 million. We did a cost segregation. We get 300,000 advanced depreciation. Up to 300,000, the client will pay no taxes. So rental income I'm talking about. So again, if you're real estate minded, think about cost segregation. A few deduction. This is specifically for retiree. A lot of retiree, Dr. Samadder, I see they still want to be busy and they do 1099 income, like locum and stuff. That should be busy. So for physician, one thing to remember, if your income is below $315,000, self-employed, you qualify for QBI. Don't forget it. QBI is called Qualified Business Income Deduction. So let's say your income is $100,000 as a self-employed. 20% of 100,000 is $20,000. You can write off as an expense on top of other expenses you have it. Number two, there's a QBI for rental income as well. There's no income restriction. So let's say you have rental income coming in, $100,000, qualified rental income coming in, you can write off 20% of the rent as a deduction as well. So don't miss those deductions. You qualify, everyone qualify for QBI for rental property. Everyone qualify for QBI, self-employed whose income is below $315,000. And last two, opportunity zone. This is again for real estate. A lot of physician, when you buy real estate, try to buy into an area. There's an opportunity zone. New York is very tough, but Ohio may be some area. Opportunity zone means there's a 20% poverty rate into an area. The beauty is once you actually buy into this property, hold it for 10 years, on a gain you pay no taxes. Again, very powerful. And lastly, this is mainly for my dentist clients. R&D tax credit. They do a lot of research. So research and development credit, there are more to it. So again, if you're a dentist or if you have like a product that actually changes people's life and process overall, you can qualify for R&D tax credit. Almost about $250,000 though. It's very powerful. So again, I'm not going to go too detailed about it. Speak to your CPA if any of the tax deduction strategy makes sense for you.
Thanks, Syed. We have some questions. Is it beneficial to include your child or children in your bank accounts? So upon your death, the child can walk in the bank and will have access to your bank account to be able to take care of filing your returns and pay any outstanding bills.
Yeah, you can actually have the children. So one thing to remember, just adding it, the person is asking, let's say if you have $100,000, you add the child 50% as an owner. I'm just talking about. So you kind of gifted the child 50,000. I hope you understand. 150, and anytime more than 17,000, the gift tax filing needs to be done. All right. And you're using your exemptions though. So it's fine to add the child. Just keep in mind the annual limit should not, exclude. And number two, the child can walk into the account. Yes, they can pay the bills. It's fine. Some people do it if the child is mature enough. Just be careful of the limit.
Okay. Rolling over IRA to fixed lifetime annuity. Can you explain benefits and drawbacks?
Yeah, so rolling over the money to a fixed lifetime annuity, there's a two type of annuity is called CRAT, CRUT. CRAT means it's a fixed income, CRUT is a variable income. So you can do this charitable design in such a way that you get annuity income from the rollover IRA. But one thing to understand that annuities are very expensive, almost like 3-4% cost that eats up, and you have to forget about the money. Once you annuitize it, the income will coming in. So as long as you are okay with it to live off of the income, forget about the rest of it. It may be okay. But again, more discussion needs to be done because we are not comfortable with the high annuity cost.
Transferring from traditional 401k IRA to Roth IRA can be done now. Is it advisable? This is for employed physicians where employer-sponsored 401k.
Yeah, so that person can just within the 401k just open up a Roth 401k and just transfer the money. It doesn't have to be like a Roth IRA. Just a Roth portion, you can just convert it within that. It's fine. Is it advisable? It's a very generic. I cannot make a generic comment, but it depending on your tax situations and everything. This is a strategy people use. Ideal candidates, the market is down, and you're in a low tax bracket. Only then it makes sense.
Okay. Thank you, Syed. Do you need a trust for husband and wife, or do both spouses share just one trust?
Depends. Again, so our clients for asset protection, I'm talking about. A lot of times, what happened that one of the spouses non-physician. Malpractice is a big issue. So one of the strategy we suggest, if your net worth is decent, let's say more than 2 million, you are a physician, your spouse is a non-physician, you can create two trusts. One trust for you, one trust for the spouse. And then transfer most of the property as long as you trust the spouse on the non-physician's name. So in this way, if a lawsuit happen, no one can go after that spouse. It will be coming on you. So it could be a way of segregating the property. So again, depending on the state you live in, depending on your situation, a strategy can be made.
Okay. How much can you write off for tax loss harvesting?
Yeah, so you can write off unlimited amount from a profit, tax loss harvesting from a profit if you have some stock market profit or real estate gain. But or let's say if you have some if you practice, you're selling it. Capital gain, you can have capital loss. But if you don't have none of these, the max is $3,000 from your
Okay.
W-2.
Wonderful. Some of the charities, especially buying granite, land, etc., you can write off up to 4.5 times, but that law has changed in 2023. Is there any other charity credit like that?
Yeah, so this land easement or land conservation, this person is talking about 4-time amount deduction, think logically. Anything too good to be true, we're not okay with. Like, you give 10,000, you're supposed to get 10,000, but this land granite, land conservation give you 4-time deduction. You put 10,000, you get 40,000. So IRS are, doing a lot of, audits are coming. So we don't feel comfortable, this kind of strategies where you get a lot of deductions. And then, Inflation Reduction Act, the government recently passed last year, and they are funneling almost $80 billion to IRS to audit people. So I highly recommend that have a good CPA before you do all of this.
Okay, someone had a question about if you can throw some light on premium single joint life with refund for long-term care.
Yeah, so long-term care, you can structure in such a way that single life, you can actually buy it, but the premium you do get it back is called return of premium if you don't use it and you pass away. It's called return of premium, like a term life. Similarly, there's a return of premium for long-term care as well. Other companies have it, is expensive. So if your net worth is less than 6 million, we recommend usually to buy some sort of long-term care. But there's a lot of them. It's just not like, like the person mentioned, you can just have a basic long-term care that will pay $200 for 5 years. That's at least the minimum you should have it. But if you have a lot of money, you think you're healthy, you will never use it. But what if, is there any way you keep paying the premium, but after 20 years, you never use it, the family gets it back? Yeah, you can have an ROP long-term care.
Okay, is the gift to child tax deductible?
Gift to child is not tax deductible. Is up to $17,000. You can gift it without incurring any gift tax.
Okay, QBI is for those active in business or also for the retired MD?
You need to have earned income, and the income needs to be below 315 to qualify for QBI.
Okay. For donations, is QCB better versus an appreciated stock?
Yeah, I mean, this is an interesting question. Whoever is asking, very savvy. Both arguments can be made. So if you think the stock will go higher, I may just keep it and do a QCD from the retirement account. That could be one option. Other option could be that I don't do QCD. I take my RMD and I can do in-kind transfer from the retirement account in a brokerage account. And then I donate my appreciated stock. So again, I have to do the number to say which one makes sense, but this is a very good question, whoever asked it, because we always take a look at strategy like this as well.
Okay. Can you touch base about long-term care insurance and paying it from your life insurance policy that you do not have a need for?
Yeah. So once people buy something called a whole life policy. So whole life policy basically have cash value, at the end of 20 years, 30 years. So one option could be most whole life have an option. You can buy life insurance in such a manner. Two options. One option could be you can have a traditional whole life policy, no long-term rider in it, that's the whole life, and you have a cash value in it. You don't need this life insurance at all, and cash value built up. One option could be if you need it, you can borrow against the policy. There should be enough dividend to pay for it, and the money you can use it for yourself. That could be one suggestion. Another suggestion could be that you can actually have a life insurance, you can buy it with a long-term care rider in it. What it means by that, if you are bedridden, you can use cash value from the policy, and the death benefit amount will go down up, while you use it. So these are the two options for the life insurance. You can have it buy life insurance with a long-term care rider, or have a life insurance, have a cash value, and you can borrow against it.
Okay, one last, that was the last. What can one do for asset protection if you're currently involved in malpractice suit and don't have a trust?
Yeah, it's like it's hard to because the person is saying that it's already in the lawsuit. Honestly speaking, nothing much. Usually all the planning should be done before that. They always call a clawback periods out there, so the person should talk to a good litigating attorney before doing anything. But our recommendation is before it happens. Like, we come into play as a financial advisor before all of this happened. While it's happening, is very hard to do planning, honestly speaking. Then at that time, now is the lawyer and you. So that's why we suggested that asset protection. We can have another webinar. We can specifically talk about FLP, Nevada Asset Protection Trust, Delaware Asset Protection Trust. Which one makes sense for you?
Okay. If you have maxed out in plan pre-tax and post-tax contribution, is backdoor or Roth conversion allowed for non-deductible IRA or Roth IRA?
Yeah. So backdoor Roth IRA is a great idea also. So backdoor Roth IRA means that you maxed out your 401k, you maxed out all the accounts, and you don't have any IRA account open. It's very important for Roth IRA backdoor to work. Otherwise, backdoor does not work. So let's say you have a 401k, you max it out, 403b, you max it out, 457, you max it out. Now you can, over the age of 50, 7,500 for you, 7,500 for your wife. You can open up a traditional IRA account, flip it to Roth IRA immediately. And once you flip it, the money grow tax-free, the withdrawals also like well. But since you immediately flip it, there's no taxes in it. So that's why it's called backdoor Roth IRA. So it's a good strategy as long as you don't have an IRA account open.
Okay. If my cost basis on appreciated stock is $1,500 for a $25,000 donation, is this better than doing a QCB for charitable donation?
Yeah, so sounds like that person, if I understand correctly, like 1,500%, if I understand correctly, is a huge gain. If you have a huge gain in a particular stock, most of the time it makes sense to donate it, because remember on the appreciation and then of the whole amount altogether, you pay no taxes in it. It's very powerful though. On the other hand, QCD, if you do the QCD, the money is never come to your hand So there's no taxes and the money goes directly from there. So that's why I suggested at the beginning, one generic comments cannot be made. Both options, an argument can be made. Which one is better? We just have to take a look at the number, which one makes sense for you.
Okay, is QBI good for W-9 income people?
QBI is mainly for 1099
1099.
schedule.
Yeah.
Yes. Schedule
What
C.
is
Yeah.
Okay, what is net million? Does it include the pre-tax accounts?
Net million.
Yeah, that's what the question.
Not sure what it means. Net million.
Which trust is better for asset protection? Irrevocable trust or revocable trust?
Yeah, revocable trust, there's no asset protection. Mainly the irrevocable trust give you the elements of asset protection. But again, the whole purpose of irrevocable trust, you want to gift it, the money is out of your state. Only then it makes sense to actually have an irrevocable trust. But again, you have to lose some control. But SLAT, as I mentioned, is a good way of doing it. If you want to retain some control over it, if you want to do asset protection, irrevocable trust.
Okay, please comment on titling joint account as tenants in common versus tenants in entirety. I don't know.
Yeah, so some states like Florida, they have tenants in entirety is the statute, is a particular type of account. The beauty is, Dr. Samadder, if you just have Florida or even Pennsylvania, the joint GTE, joint tenants of entirety, is a very strong asset protection if a lawsuit happen. So the state statute protects it. So that's why depending on the state you live in, GTE, if the state allows it, go for it, versus joint tenants in common or joint with right of survivorship. GT is very powerful for asset protection.
Okay, what age can minors open Roth IRA, and can their earnings of say 15,000 go straight to IRA?
Yeah, so the minor, as long as they have earned income, they can open up a Roth IRA. But the max limit, as you know, is about $6,500.
Can a person still open backdoor Roth IRA if he or she already has a SEP IRA program account?
No, remember SEP IRA, as I mentioned, those should not be open because what happened, those are included when you do a backdoor Roth IRA in the calculation. So in order for a backdoor to work, you should not have any IRA account open, only 401k or defined benefit, those are fine. Then you should do a backdoor Roth IRA.
Do we pay capital gains in foundation accounts?
No, capital gain, buy, sell, whatever you do in the foundation, there's no taxes. No.
Okay, how about family limited partnerships? Do they protect assets?
Yeah, some state have FLP, family limited partnership. I think Dr. Samadder, we should do a webinar about asset protection. There's a lot of questions.
Probably,
Yeah,
yes.
yeah.
So I think we are coming pretty close to, I don't know
Pretty
what
close.
time is it.
It's almost
Yeah.
9. Yep.
Okay, what is I'll ask one last question. What is QCD versus QBI?
Yeah, QCD is qualified charitable distribution. So after the age of 73, according to the Secure Act, you have to take RMD from the retirement account, but that the income is part of your adjusted gross income. One option could be don't take RMD from the retirement account, give directly donation from the retirement account to the charity you want, or you can create your private foundation and transfer money over there. It's called QCD. QBI, on the other hand, is like if you have a 1099 income, if your income is below 315,000, you qualify for QBI, which is 20% of business income. So let's say the business income is $100,000, 20% of 100 is $20,000 is the deduction the government give you on top of other deductions you get.
Okay. Thank you, Mr. Nishat. You've been very kind and we are really grateful to you. And he has been kind enough to offer to have a discussion on asset protection, which he'll host next month, and we'll keep all of you informed about it. Thanks again, everyone, to join this webinar. This video will be available online and will be emailed to everyone. Thanks again, Wall Street Alliance Group, for this great educational webinar. Thank you.
Thank you. Thank you, Dr. Samadder, for inviting me to
Appreciate
your webinar.
everything.
Appreciate it. Thank you.
Thank you.
Bye-bye.
Thank you.
Have a good
Bye-bye.
evening, everyone. Bye-bye.
You too.